What are default fears and how they can affect your investment decisions negatively by making you too risk-averse or too optimistic? Default fears are psychological tendencies that make us avoid or seek out certain outcomes based on our expectations and emotions. They can influence our investment decisions in ways that are not always rational or optimal. One type of default fear is the fear of failure. This is the fear of losing money, reputation, or self-esteem by making a bad investment. People who have a high fear of failure may choose to play it safe and avoid taking risks that could potentially lead to higher returns. They may also set lower standards for their performance and focus on minimizing losses rather than maximizing gains. Another type of default fear is the fear of success. This is the fear of achieving more than expected, which could bring more responsibility, visibility, and pressure. People who have a high fear of success may sabotage their own chances of reaching their goals by procrastinating, making excuses, or underperforming. They may also feel guilty or unworthy of their achievements and worry about losing them. Both types of default fears can affect your investment decisions negatively by making you too risk-averse or too optimistic. Being too risk-averse means you miss out on opportunities that could enhance your wealth and well-being. Being too optimistic means you ignore the potential downsides and overestimate your abilities and luck. How can you overcome your default fears and make better investment decisions? Here are some tips. Recognize your default fears and how they influence your behavior. Are you afraid of failing or succeeding? How does that affect your choices and actions? Challenge your default fears with rational thinking and evidence. What are the realistic chances of failing or succeeding? What are the benefits and costs of taking or avoiding risks? What are the facts and data that support or contradict your fears? Set realistic and attainable goals that match your skills and resources. Don't aim too low or too high, but find a balance that challenges you without overwhelming you. Seek feedback and support from others who can help you improve your performance and confidence. Learn from your mistakes and successes, and celebrate your progress. Practice positive self-talk and affirmations that boost your self-esteem and motivation. Remind yourself of your strengths and achievements, and tell yourself that you deserve to succeed. By overcoming your default fears, you can make more informed and balanced investment decisions that reflect your true values and aspirations. One of the key factors that can affect your investment strategy is default risk. Default risk is the probability that a borrower fails to make full and timely payments of principal and interest on a debt obligation, such as a loan, a bond, or a credit card. Default risk can apply to both individuals and companies that borrow money through loans or by issuing bonds. Default risk can have a negative impact on your returns if the borrower defaults on their debt and you lose some or all of your invested capital. So how can you assess your default risk and diversify your portfolio to reduce its impact on your returns? Here are some steps you can follow. First, you need to understand your own risk tolerance. Risk tolerance is the degree of uncertainty that you are willing to accept in exchange for a potential higher return. Risk tolerance varies from person to person depending on factors such as age, income, goals, and personality. Generally, the higher your risk tolerance, the more you can invest in risky assets such as stocks and bonds that have higher default risk but also higher expected returns. The lower your risk tolerance, the more you should invest in safer assets such as cash and government securities that have lower default risk but also lower expected returns. Second, you need to evaluate the default risk of the securities you are interested in investing in. One way to do this is to look at the credit ratings of the securities. Credit ratings are opinions expressed by independent rating agencies such as Standard & Poor's, S&P, Moody's, and Fitch ratings on the creditworthiness of a borrower or a debt issue. Credit ratings are usually expressed by letters ranging from AAA, the highest rating, to D, the lowest rating. The higher the rating, the lower the default risk and vice versa. For example, S&P assigns AAA rating to securities that have an extremely strong capacity to meet their financial obligations, while it assigns D rating to securities that are in default or in breach of an imputed promise. Third, you need to diversify your portfolio across different types of securities, sectors, industries, countries, and maturities. Diversification is a strategy that involves spreading your investments among different assets that are not perfectly correlated with each other. This means that they do not move in the same direction or by the same magnitude in response to market conditions. By diversifying your portfolio, you can reduce the overall default risk of your portfolio and smooth out your returns over time. For example, if some of your bonds default due to a recession, you may still have positive returns from your stocks that benefit from a recovery. Similarly, if some of your domestic securities suffer from political instability, you may still have positive returns from your international securities that are unaffected by it. To summarize, default risk is an important factor that can undermine your investment strategy if not managed properly. To assess your default risk and diversify your portfolio to reduce its impact on your returns, you need to understand your risk tolerance, evaluate the credit ratings of the securities you are interested in investing in, and diversify your portfolio across different types of securities, sectors, industries, countries, and maturities. One of the main risks of investing in bonds is the possibility of default. This is when the issuer of the bond fails to pay back the principal or interest to the bondholders. Default events can have a significant impact on your investment strategy, as they can reduce your returns and increase your losses. How can you monitor the economic and political factors that can increase the likelihood of default events and adjust your strategy accordingly? Here are some tips. Keep an eye on the credit ratings of the bonds you own or are interested in. Credit ratings are assigned by independent agencies such as Moody's, Standard & Poor's, and Fitch, and they reflect the issuer's ability and willingness to repay its debt obligations. A lower credit rating means a higher risk of default and vice versa. You can find the credit ratings of bonds on various websites and platforms, such as Bloomberg, Yahoo Finance, or Morningstar. Follow the news and developments in the countries and regions where the bonds are issued. Economic and political factors can affect the issuer's solvency and stability, and thus its ability to service its debt. For example, a recession, a currency crisis, a trade war, a social unrest, or a political turmoil can increase the risk of default for some bonds. You can use reliable sources of information such as newspapers, magazines, podcasts, or blogs to stay updated on these factors. Diversify your portfolio across different types of bonds, issuers, sectors, and regions. Diversification can help you reduce your exposure to specific risks and mitigate the impact of default events on your overall performance. For example, you can invest in a mix of government and corporate bonds, high-yield and investment-grade bonds, domestic and foreign bonds, etc. You can also use bond funds or exchange-traded funds, ETFs, that invest in a basket of bonds with different characteristics. Review your portfolio regularly and rebalance it if needed. You should periodically check your portfolio to see if it still matches your risk tolerance, return expectations, and investment goals. If some bonds have become too risky or too expensive for you, you may want to sell them and replace them with other bonds that suit your profile better. You may also want to adjust your portfolio according to changing market conditions and opportunities.